We can beam high-definition video across the globe in milliseconds, but try to move $1 million from New York to Singapore, and that speed instantly hits a wall. Traditional finance still operates on an analog clock. Markets close at 4 p.m., weekends don't exist for wire transfers. We settle trades on a 2-day delay, the infamous T+2, and rely on a daisy chain of correspondent banks, clearinghouses, and brokers taking a cut at every border crossing. For decades, low interest rates masked these inefficiencies, but with capital costs hovering at multi-decade highs, locking up billions of dollars in transit for days is a massive drain on global liquidity. The infrastructure needs an upgrade. The solution is the tokenization of real-world assets, taking the legal ownership of a physical or financial asset, like real estate or a corporate bond, and converts it into a programmable digital token. That token can be fractioned and sent anywhere, settling instantly without a centralized hub. By 2030, this ecosystem could balloon to $30 trillion, representing a massive slice of global GDP migrating on-chain. We are looking at a structural rewiring of the global economy, designed specifically to make money move at the speed of light. Speed is only half the equation. The real breakthrough happens when passive financial instruments become self-governing. To understand how, we have to look at the code. Protocols like the ERC 3643 standard serve as the technical rulebooks for compliant tokenization. Instead of relying on a compliance officer to manually verify a trade, rules regarding investor identity, jurisdiction, and offering limits are baked directly into the token smart contract. If a buyer doesn't meet the criteria, the transaction fails. If they do, it clears automatically. The armies of middlemen, the lawyers, the clearinghouses, the transfer agents, fade away. Two parties can trade directly with absolute cryptographic certainty that the transfer is legally compliant. By replacing human bureaucracy with automated code, continuous, frictionless markets are a technological reality. The migration to these new rails is already underway, and it is starting with the most highly liquid assets on the planet. Look at the trajectory on this chart. In the first quarter of 2026, the total value of tokenized U.S. Treasuries spiked past $13.4 billion. At the same time, tokenized commodities, driven largely by vaulted gold, climbed past $7.3 billion in market cap. The architects of traditional finance are driving this volume. BlackRock launched its tokenized treasury fund, BUIDL, which now connects directly to decentralized exchanges, bridging the gap between regulated Wall Street structures and open crypto networks. Meanwhile, JP Morgan has processed over $1 trillion in intraday repurchase agreements using tokenized assets on their own platform. Even the exchanges are building new architecture. NASDAQ developed a hybrid system allowing traditional stocks to settle as digital tokens, while the New York Stock Exchange is building a fully continuous 24/7 on-chain trading venue. The titans of traditional finance aren't fighting blockchain technology. They are actively co-opting it to upgrade their own operating systems. The scope of tokenization is expanding rapidly beyond government bonds and stocks. It is now wrapping around massive, heavy infrastructure. Take this LNG tanker. Through platforms like InvestaX, the bridge financing for an entire Indonesian shipping vessel was successfully fractionalized and offered to investors on-chain. And because these assets are programmable code, they can be managed by artificial intelligence. Specialized AI agents hold, trade, and rebalance portfolios of real-world assets around the clock with zero human intervention. We have the technology to make markets hyper-efficient, but access to this infrastructure is being artificially throttled by outdated policy. Current SEC frameworks mandate that most tokenized assets be treated as traditional securities, and strict accounting rules penalize financial institutions for holding digital assets on their balance sheets. The result is a walled garden. Tokenization has created a frictionless, high-speed lane for institutional giants and accredited millionaires, effectively locking out the everyday retail investor. The global financial system has officially upgraded to broadband, but until regulatory frameworks evolve to democratize access, the average investor will be left buffering.